Welcome to CMC's market video for Thursday the 28th of August. I'm Rick Spooner. We've seen a pretty significant decline in energy prices in recent weeks. There have been a number of factors behind that. Possibly the main one, I think, has been that the markets collectively came to the view some weeks ago that it seemed now a lot less likely that the situation in either Iraq or Ukraine was going to deteriorate to the extent that they posed a significant threat in the short term anyway to oil and gas supplies. A second factor has been recent strength in the US dollar, because energy prices are quoted in US dollars. Then a stronger US dollar tends to mean weaker prices. And a third factor is that energy markets have generally had excess capacity in recent years, against a background of pretty moderate world economic growth, and also, of course, because of the US shale oil phenomenon, which has certainly changed the balance of supply and demand, particularly in the US. One of the many commodity contracts that you can trade on our platform is the US natural gas. It's one of the major traded energy products, and indeed one of the major traded commodity markets. Despite the big downtrend that we've seen over the past couple of months, there have been signs of it lifting off the bottom and forming a basing pattern on the chart in the last week or two. For those not familiar with the US natural gas market, it makes up about 25% of total US energy demand. And one of the reasons it has been rallying in recent days is a prediction that the cooler weather that normally comes about in the US autumn may be a bit delayed, and that it looks as though we might see warmer weather into the first few weeks of September. And the connection there is that around about 30% of total US gas demand goes to power generators. But just to focus in on the chart, and what I'm looking at here is the October 2014 daily CFD chart. You can access that via the product library in the commodities section. As you can see, large ongoing downtrend, but recently a couple of trend lows at pretty well the same level, which certainly has the look about it of a potential double bottom pattern. Now, a double bottom pattern is not completed unless and until there's a break up above the peak between the two lows, and as you can clearly see, we're getting very close to that possibility now. So from a standard double bottom type strategy point of view, a typical way of handling this would be to enter with some sort of stop entry above this peak. If price was to get up above that level, and possibly just allowing a bit of a filter to make sure that there looked to be a distinct break above it. How far might things go if we get a setup here? Well, one typical approach to double bottom strategies is to use the height of the pattern itself and to project that from the break point. I've done that using the Fibonacci tool here, and you can see that that cuts in at around about 4.33 or $4.33 per British thermal unit, which is how this contract is quoted. A standard approach to a stop loss is to put it right down behind the double bottom lows. But what can often be quite effective is to use a more aggressive stop loss and to look for a support level back inside the chart pattern, which provides a closer stop level. Here I've used this dash red line to just join up some potential candle highs and lows at around about $3.88 or thereabouts. If we do get a break and a double bottom set up here, then there may well be an opportunity to move the stop loss up as the trade unfolds. And if that happens, I'll come back to this setup in future videos. Thanks for joining me today.